What's up, Rowan here from Art of Smart Education with the weekly HSC Economics stats update. In this episode, we're looking at all things wages. ABS dropped some wage data. We're going to look at the implications for real incomes, inflation, unemployment, and government policy. If this is your first time dialing in these episodes, I summarise the key headlines from around the domestic and global economy, giving you the key insights and analysis you need to unlock a Band 6 in the HSC Eco course. Let's jump right in. Wage price index versus September reference period by the ABS shows a 3.5% increase over the year in wages. So on the face of it, looks really good. Now the reason we want to think about this is, okay, what is inflation? Headline inflation was 2.8%. So you can argue, great, we can see that real incomes are going forward, right? They're actually improving because the gap, wages have gone and increased at a greater rate than headline inflation. Now, the thing to note though, unfortunately, the true mean or the underlying inflation rate was 3.5%. So maybe the impact into real wages or real incomes is not as significant as we think. Now, note, The Guardian has a couple of fantastic pieces of analysis on this, and Greg Jericho in particular, which we're going to unpack. Now, one of the things we want to consider here, okay, is first of all, this was fairly expected. Note that in the prior quarter, it was 4.1%. So, the 3.5% is what we're seeing a slowing of, wage growth. And we can see that here. We can see that growth, and now we're seeing a slowing in that. And that's expected. The RBA's expected it, and economists have expected it as well. And in part, that is because of the fact that we've seen, contractionary monetary policy really sort of putting skids and slowing the economy. Yes, unemployment still remains very, very low. And as we looked at in last week's episode, some of this all turns upon the question of, what the NAIRU is. So if you've missed that episode, I encourage you to jump back and watch it because it's going to provide useful context for some of what I'm sharing today. Now, why could we say, though, what has driven, some of this, increase, right, in terms of the 3.5%? Now, one of the things that, has been identified here is ultimately that, and this is from Michelle, from the head of price and statistics at ABS, is that ultimately wage rises for many jobs can be directly or indirectly linked to the outcomes of the Fair Work Commission and the annual wage review decision. That happened, and there was an increase that resulted of a 3.75% wage increase on the 1st of July. So that really flowed through in this quarter, okay? Now, of course, we're looking at an annual rate. It was a 0.8%, for the private sector, for example. If we go back, we can take a look, but also the public sector. So both sectors rose at similar levels. But the argument here is that a lot of this has probably been driven by this increase in the minimum wages across all of the awards as part of the Fair Work Commission. So one, you can utilise this when you're looking at micro reform in the labour market, you're looking at the role of centralisation and the awards in terms of looking at wage outcomes, okay, which is fantastic to see. Now, what of all of this? Okay, I think it's all well and good to say, great, wages are going up, and maybe real incomes are increasing. Is this actually true, and how can we utilise this to really analyse policy effectiveness a little more? And so, Greg Jericho, fantastic piece here at The Guardian. So I think the first thing to highlight here is that this slowing of the wage price index, right, which we identified, this is the biggest one-quarter fall since the GFC in 2009. So, and you can sort of see, the difference here in terms of what it looks like from 4.1 to 3.5, and he's arguing, okay, we've seen some, not from here, but going back, we'd need to go back all the way through to here, right, where we're looking at 3.8 down to 3, okay? So we've got some other periods, obviously, when COVID hit, but it's actually, notwithstanding COVID, it's actually the largest fall since, the GFC. Now, what this says is arguably that, we've had a very temporary blip in wage growth occurring, and therefore maybe real incomes trying to sort of catch up with all of the damage that inflation has done in eroding purchasing power. But it looks like this might be shifting, and that's certainly something that Greg has more to say on this as well. Now, one of the things that you could argue here, and this is maybe some analysis of government policy, is that that the Labor government and Anthony Albanese had back in 2022 really supported minimum wage rises of 5.1%. Right now, part of that was on the basis of trying to really support improvements in real wages. Now, why are real wages or real incomes important? Well, at the end of the day, if real incomes are going backwards, consumers' ability to spend and consume is going to also erode, and that's going to impact consumption and therefore economic growth in an economy. So the reason wages are important is that one, they tell us maybe what's going on in the labour market. If wages are not growing that quickly, it means we've got excess capacity, right? It might mean the labour market is softening, okay? On the flip side, okay, wages also give us an indication of maybe inflationary pressure through cost push inflation. okay? But they also then indicate, purchasing power for, households, okay, relative to the rate of inflation, and therefore what's going on for economic growth because of its flow through consumption. So we can see how wages really have this quite connected impact across a number of the economic issues that you'll be unpacking as part of the HSC Economics course, and so it pays to understand the role that they play. So the argument at the time was, well, hey, we can't see wages go up too fast, even though real wages have gone backwards because of this breakout of inflation during COVID. If they go up too fast, we might end up into a period of a wage price spiral where, the increase in wages, causes cost push inflation that gets pushed on, and we see worsening inflation, which in turn then further erodes real incomes, which basically, undoes all of the work that those wage increases were designed to do. Now, it was unlikely at the time that it would cause a wage price spiral, but that was one of the things the RBA was concerned of. Now, of course, I think we can see that never has eventuated. So, okay, great. On the one hand, that has not occurred in the Australian economy, and so it's not driving inflationary pressures. On the flip side, though, okay, is I guess the real challenge, right? That if we have a look here, this is a fantastic diagram that shows, okay, this is the trend, okay, from wage growth from 1998 to 2012, basically. And you can see that, okay, you can see which years were mapped on it, okay? But broadly, that trend line is somewhere, really from 2.5% up to 4.5%. Now, unfortunately, okay, the 2016 to 2020 trend looked quite different, okay? And we can see that was, at a high of just over 3%, to a low, trend line sitting in the ones, right? And the low ones. Now, the challenge is the data that we've got here, you can see, sits pretty much smack in between these two trends, okay? And it is a little bit of the outlier. It's not entirely the outlier, to be fair. And I think, the Guardian is in purpose trying to sort of maybe highlight, well, look, maybe it's a bit closer to this one. To be fair, there's probably some more data here, right, that has been grouped in the 1998 to 2012 trend. But the indication is that we may be moving back down to this trend here. And so what is the concern for that? Well, the concern for that is during the 2016 to 2020 period, known as a period often called the secular stagnation, we had very slow wage growth, okay? And that then contributed to one, inflation that was, the opposite problem to what we have now. It was below the bounds and we couldn't get it up into the bound. And we had quite anemic consumption, anemic economic growth. And it was really hard to get the economy going. And so the concern is, well, we could be heading back, as inflation continues to normalise, right, and come back into the target. The problem is we may be heading more to a situation there. And then on top of that, right, is an issue that, well, we've had these period in these years of inflation, right, during COVID, which we haven't really then had, wage growth sort of kick in to address that. And we can sort of see that, okay, in terms of the impact. And this is, I think, really fantastic further data which shows, okay, ultimately the official inflation figures don't count mortgage repayments, right? So they're really, in some respects, a bit of a disingenuous sort of data point, right? Because you look and go, oh, well, inflation's coming down. But the truth is, for at least a third of the population that have a mortgage, their actual cost of living, right, which is why cost of living has become a term that's now used so much more, is significantly different, okay? So since March 2020, the cost of repaying a mortgage has increased 155%. Because interest rates, have increased in the past year, rather than a 2.8% inflation rise, therefore, an employee household cost of living rose by 4.7% actually, okay? So what that means is that rather than real wages increasing, if you count mortgages, okay, your ability to buy things with your wage over the past year actually has fallen by 1.1%, okay? And we can see that here, okay, that 1.1% fall. So we can see not looking good really, since, certainly, it's particularly worsened since mortgages have started increasing. So, if we use CPI, okay, it looks very different, okay? It looks pretty good recently, okay? Like we're just hitting slight improvements in real income. Of course, though, those improvements there, okay, don't really offset the significant decreases that have occurred here. But certainly if we look at it through a cost of living, we've never really got back to a point, okay? And so ultimately the argument is that even, worth, right, workers now over the last 3 years arguably have lost 9% of their purchasing power, okay? And so the real challenge here is what that does is it impacts consumption, okay? And it's why arguably right now we're in a per capita recession, okay? Per capita, we're spending less, okay? Retail trade is down per capita, right? What's keeping us afloat in many respects is, immigration, our population is growing, and as a result, we're spending more net total, but it's not at a per head basis, okay? And a lot of this comes back to this issue here. Now, of course, how do you continue to manage this, right? It is a tricky issue because ultimately you do want to get wage growth, but you don't want to have so in a way that is not also aligned with productivity growth, because otherwise you can lead to cost push inflation and worsen in inflationary pressures. The challenge for the Australian economy is that our productivity is also flatlining and has flatlined for some time. And so really a big criticism that can be really raised here for Labor, but certainly Liberals before, is that there's a real need to conduct and look at much more serious structural reform in the Australian economy, whether or not that is tax policy reform or otherwise, okay? And that reform is not happening because it is also potentially, really big political limitations, unlikely to get, elected again. Neither side of politics really want to touch it. But the result is, therefore, that we're not really dealing with productivity growth in the way that we need to support wage growth, in the way that we need to really then return the economy to, a stronger footing from an economic growth perspective. So hopefully you can utilize this as part of your analysis, right, as you start to look at the effectiveness of policy, but also the limitations that come from it. What I would say as I wrap up this episode is that wage growth is actually a really important concept. It doesn't get enough of a look in itself in the HSC Economics course, but that's because it largely sort of falls between the gaps between inflation, unemployment, and economic growth. But it is one of those key concepts, right, that is very, very powerful because it also links into the labour market. So it's a concept that really touches upon 4, if not more, areas of the course. It obviously also touches upon, fiscal policy, monetary policy in terms of their impacts on it. And so it's one, and income distribution at the end of the day. So it's one that pays to really get your head around because it's going to come in very, very handy across significant parts of the course. If you have any questions, drop a comment below. Otherwise, if you're needing more support in the HSC Economics course as part of Term 1 2025, I'm opening a class that I will be leading for the HSC Economics course at our new campus at Chatswood. We'll be doing a deep dive into topic 2, balance of payments, current account, exchange rates, and more. It's one of the most difficult topics in the entirety of the HSC Economics course. Students consistently rate it that way. So if you'd like to join my class and really master the HSC Economics course and unlock that Band 6, drop a comment and submit your details and we can get you some info. Otherwise, have an amazing week and I'll see you next week.